Welcome to the Practice Masterclass presented by Magentis. Today we are going to move into the broader finance space with financial strategies for running a successful private practice. Joining us today is Hugh Walsh, Director of Walshs Accounting and Taxation. Walshs is one of Queensland's leading financial planning, accounting and lending firms for medical and private clients. In this episode, Hugh will provide insight into choosing the right structure for your practice, practice finance best practices, and setting and tracking your practice performance KPIs. Here's Hugh.
Welcome, and in today's episode we're going to be discussing financial considerations and strategies to support your private practice. When starting out in private practice, there's so much to consider. Insurances, registrations, structure, staffing requirements, marketing. It can of course be quite overwhelming. Our role today is to talk about the financial considerations when starting out in private practice. So, which structure do we set up when we're starting out in private practice? Of course, this can be quite overwhelming, and you may have heard of many different types of structures in the hospital hallways. You can set up as a company, as a trust, or even a sole trader. So let's talk about each one of them. So a company, the three key elements are a company constitution, the directors, and the shareholders. So a constitution is the rule book, the one that governs what the company can and can't do. The directors, well, they control the trust, they control the company. And shareholders, they own the shares in the company. They have access to the right of income and capital via dividends. A trust has different forms. You can have a fixed trust, a family trust, a discretionary trust, and a hybrid trust, all various types. But the three commonalities between them are a trust deed, which is the rule book that controls what can and can't do. A trustee, which is the person or entity which governs the trust and tells it what it can and can't do and makes the decisions on behalf of the trust. And beneficiaries. Beneficiaries are the recipients of the income and capital from the trust. And finally, we have sole trader, certainly the most simplest of the three. A sole trader is essentially you're carrying on a business in your own name. So when starting out in private practice, it's really important that you take time to consider the options for your private practice. The structure you dictate should be compliant with the ATO guidelines, while at the same time yielding additional tax benefits where possible. Certainly, choosing the wrong structure can make a huge difference to your wealth and financial security. So let's just break down each of the various structures based upon the difference between cost, asset protection, and tax. So for starting off with the first one, a sole trader, we can see there that it's very low cost to set up and ongoing administration, has low asset protection, which is not necessarily the best, and it has the highest tax rate, of the top marginal tax rate in Australia being 47%. A company, on the other hand, has high cost to set up and high ongoing cost to administer, medium asset protection, and does get access to a lower tax rate of only 25%. And then a trust, if it's a discretionary or family trust, has high cost, high asset protection, and the tax rate is that of the beneficiary's marginal tax rate, the ultimate recipient of that income. So when you're looking at this slide, you may think, the company tax rate looks very appealing at 25%. But unfortunately, we have to comply with ATO guidelines. And we deal with this one key element called personal services income, or as the ATO like to call it, PSI. So generally, the income derived from a doctor from their own personal exertion, seeing patients, operating, needs to be taxed in their own name. The income must flow through and be taxed in the individual's name. So even if you set up a company or a trust, that income must flow through and be taxed in the individual's names. So that company tax rate of 25%, well, we don't get access to that with our personal services income. And if we hold, in terms of asset protection, if we hold assets in our spouse's name or in other entities, we can deal with that asset protection issue, which leads us down the garden path that in fact operating as a sole trader is going to be the most appropriate in terms of the ATO guidelines. Okay, so a sole trader. There's lots to consider. I did say it was pretty simple, but there's still a long list of activities that need to be considered. We've talked about PSI. The next one is ABN and GST registration. So an ABN is an Australian business number. Very easy to get. Go online and register within a few minutes. GST registration. So if your private billings are greater than $75,000 over a 12-month period, you need to be registered for GST. This is even if the income that you derive is medical services income, which is GST free. And in fact, you're incentivized to be registered for GST because all of your expenses now have that extra 10% cost, which you can claim back as a GST credit. Medical billing and revenue collection. How are you going to receive your income from your patients? Okay, you're going to need some great software. You're going to need some great practice management software, like Magentis, of course. And of course, you're going to need bank accounts to receive that income. So we always encourage our clients to set up their own business bank accounts. You don't want this income from your patients flowing into your personal accounts that you may share with your spouse. You need to have that separate bank account to keep track of all of your income and expenses. Deductibility of business expenses. Now that we're carrying on a business, the opportunity to claim more expenses is far greater. Things like motor vehicles, conferences, and even employing our spouse, something I'll touch on a bit later. Bookkeeping and software, really important. How are you going to keep track of all your income expenses and what software you're going to use? And making sure it interacts with your practice management software like Magentis. So Xero, we think, is the market leader in this regard, the accounting software. So it's cloud-based, very easy to use, and would encourage all of our clients at Walshs to do that. I've talked about business bank accounts, and the final one is service agreements. So if you are working at a practice, working with other groups, it's important that you have service agreements. No doubt something that Hillhouse Legal Partners would have touched on in their episode. So, tax planning strategies. This is where it gets exciting and where we can add value to our clients. PAYG installments and the tax honeymoon. I have a separate slide on that, so I'll come back to that. Business loans and deductibility. So the ability to borrow to pay for business expenses and claim the interest on that debt is now available to you if you satisfy those PSI rules, okay? So the opportunity to, pay for things through your business, pay for tax expenses, pay for services fees through borrowing and restructuring your debt through debt recycling allows us to claim the interest on that. Superannuation. Now that you're in private practice, and if you're 100% in private practice, you may not have any superannuation coming into your fund because the opportunity and obligation now sits with you as the income recipient and the taxpayer. So you want to make sure you're keeping up with your superannuation contributions and providing for your retirement. The maximum you can put in this financial year, being FY25, is $30,000. And if you're a high income earner, you want to make sure you're maximising that cap every year. Employees. You can employ people such as nurses, admin staff, and even your spouse to carry out those admin services for you. Now, the ability to split your income with your spouse is a great opportunity in making sure you're still compliant with the ATO guidelines. And certainly for all of our clients who we set up, who are employing their spouse, we make sure we tick all the boxes. We register for PAYG withholding. We make sure that work cover's in place. We set up SuperStream and make sure super's paid each quarter. And we do the single touch payroll via the ATO clearinghouse. One of the biggest things we see with our clients is how do they pay their tax when in private practice? The goalposts have shifted now. We're no longer an employee and we no longer have PAYG withholding taken from our salary each fortnight or month. So the opportunity, or should I say obligation, now sits with you as a taxpayer to manage how you pay your tax bills. And certainly getting good advice from a medical specialist accountant is going to be the right advice here because you can get caught out. I use this example on the slide here as if we're starting out in private practice on the 1st of February 2025. And if we work those 5 months all the way up to the end of the financial year, being 30th of June 2025. If you receive private income of, let's say, $100,000, all of that income is untaxed. It's going to look very healthy in your bank account, okay? And when do we have to pay the tax on that? So assuming that it's a top tax rate of 47%, so it's $47,000 of tax to pay, roughly. It needs to be paid when we lodge the tax return for the FY25 year. which is not due until the 15th of May 2026. So there's a period from February 2025 to May 2026 where you don't pay any tax on your private income. Not only the first 5 months of that FY25 year, but also there's 11 months of the FY26 year. So there's a big sum of money that's going to be flowing into your bank account. And we don't want to lodge that tax return any earlier. We want to lodge it on the due date and pay it on the due date. Why? Well, we want those funds ideally sitting in a high interest savings account, or even better if you have a home loan, in your offset account. We want to make sure we preserve those funds and don't go out and buy fancy cars just yet. That time will come. And of course, once we lodge that tax return, the ATO becomes aware that you're making all this great money privately, and they're going to put you on what's called the PAYG instalment program, Pay As You Go instalment program. So different to Pay As You Go withholding. Now, each time you have to pay a quarterly tax bill via your quarterly business activity statement. And as our clients, we manage those payments for our clients and make sure they know like 12 months in advance of when their tax bills. There should be no surprises with managing your tax bills if you have a good accountant in your corner. Service entity types. So when you're starting out in private practice, you may start working for a larger group, and when you get further down your private practice pathway, you may look to start your own practice. So let's just break down this slide a bit. On the left, you have Dr. Low, Dr. Medium, Dr. High. All of those doctors are set up as sole traders, and they're receiving their private patient fees into their own names. But in that entity, that service entity, that's the practice. That's where you see the admin staff might be employed from, the practice manager. That might rent the rooms, provide all the medical supplies, the IT, the finance support for the doctors. So the doctors can turn up, see their patients, and be looked after by the practice. It works really well when you've got a multi-practitioner group of doctors. That service entity receives income. The income is service fees. The service fees are paid by each of those doctors based on a percentage of their billings. That can range between 30 and 40%. The service entity then pays for the expenses. It pays for wages for staff, it pays for rent, medical supplies, and after that it's left with profit. But that profit is business income. This income is different to the personal services income that needs to be maintained in the doctor's tax returns. Business income can be distributed out to other family members. So this is when we start talking about companies and trust. We've talked a lot about sole traders. A service entity, the most common structure, would be a company, okay? And that, once again, if I refer back to previously, a company has shareholders. In this structure, the shareholders of the respective family trust. It has directors, which would be the doctors working in that entity, and has a constitution which governs what they can and can't do. So any profit flows out of that service entity company into the respective family trust of Dr. Low, Dr. Medium, Dr. High. In a scenario where we have a spouse who is on a lower tax rate, we're able to stream that income out to that spouse or adult children and get access to lower tax rates. Because we know as a doctor, it's likely going to be taxed at 47%. So this is a very common structure for a group of multi-practitioner doctors. Practice finance. So just jumping ship a bit here, just some really key things to think about in your practice, and maybe something your accountant or bookkeeper will be talking to you about. The first one, of course, is use a medical specialist bookkeeper or accountant. There's lots of firms out there who profess to understand how doctors receive income and the intricacies of how it works. There's lots of firms out there who profess to know how doctors receive their income and pay their bills. But certainly, there's also even better firms that actually do this well, who are specialists in the medical industry. So do your research and find the firm, such as Walshs, who can support you through this. I've talked about cloud-based accounting software. I've talked about Xero. It's the best software out there, and MyOb's also very good, of course. Ensure quality and consistency in your reporting. So having good processes and systems to track income, track expenses, to report it. Setting up a chart of accounts. So a chart of accounts is essentially all the accounts that your income and expenses flow through on your profit and loss statement and your balance sheet. Making sure that's clear, it's not messy, you're getting advice on how to set it up correctly. Regular reconciliations. Now certainly something you as a doctor should not be doing. you should be outsourcing this to a bookkeeper to make sure they keep on track. Every fortnight, every month, you want to see your accounting software being reconciled. And of course, a regular review of your profit and loss and balance sheets. This is important to keep track of the financial performance of the practice. You want to make sure, if you're working really hard, that the practice is doing well. And then these reports allow you to track that historical data. Practice performance. So these are 5 key KPIs we talk to our clients about. So average billings per week. How much are you billing from your consulting and from your cases in operating per week? And having a comparison month on month, week on week, year on year to track that. The number of consults per week. Consults generally going to lead to surgery, depending on your specialty. But certainly, the more consulting you do, potentially the more access you get to doing cases and surgery. The number of referrals to week. So who is your referring party? Are they GPs? Are they other specialists? How are the referrals being tracked? And are you monitoring that and keeping a track on that? The value of outstanding debtors. So the worst thing is to do is to work really hard and then not get paid. So not get paid by the patient directly, by the health funds, or by Medicare. So making sure you have someone in your practice who's using the clinical software, such as Magenta's well, to really keep track of the debtors. And of course, a simple one, monthly expenses versus budget. Does your practice have a budget to manage expenses, to keep track so that you don't spend too much money in the practice? Practice premises. So where are you going to be located? There's 3 generally models here. You've got your virtual, your leased, or your owned. The virtual model, I think, is a great one to start out on. If you're just dipping your toes into private practice, then this is a pretty great model. No costly overheads, greater client reach, it's efficient, it's effective, and it's just really simple to get started. It's sort of a pay-as-you-go model. Then you might move to a lease scenario where you might find some premises close to a hospital where you might lease your rooms. Generally a really good idea to lease before you buy, to make sure where you're taking up is the right place you want to be. It's of course less upfront cash. You're not going to have to go out and buy rooms or worry about finance. Greater flexibility. If 3 years into your lease you realise, hang on a minute, I'm at the wrong hospital here. I want to be on the north side or the south side of the city. The ability to exit that lease and then move as opposed to owning. Less of control, of course. The landlord can come in and kick you out at any time, subject to the lease terms. And there's no equity or growth in the rooms. Owning your rooms, I think a great strategy long term for doctors to own their own premises. The biggest risk in owning commercial property, which is what your rooms will be, is tenancy risk. So tenancy risk is essentially you're the landlord and you have no tenant and therefore you're not receiving any rent. In a scenario where you're the landlord and the tenant, then you've mitigated that number 1 risk of commercial property. It's a great asset class to own to grow your wealth. It is a complex structure to set up, depending on how you're going to structure it in which entity. It does require a lot of finance. There are potential CGT concessions, capital gains tax concessions. Certainly getting assistance with finding a location. There's firms out there who assist the doctors in the buyer's agents to go out and negotiate and find sites. Looking for lease incentives, negotiating the terms, I'm not a specialist in property, just like many doctors aren't specialists in property. Leaning on the firms out there who can provide that specialist advice. But long term, owning your own rooms is a great asset class to own for doctors. Financing and lending. So whether we're buying a practice, we're doing a fit out, we're buying rooms, lots to consider here. And there's definitely specific medico lending policies for doctors that need to be factored in. So if you're looking to buy a practice, so an existing practice that might exist, firstly you need to consider what's the practice worth. Let's not forget that a lot of the value or goodwill sits with the doctor themselves. So if you're buying the business of another doctor, is there any value that attached to that? Or can you just go and start your own practice? Certainly there might be a cost to buy the fit out, to take over the business, the staff, etc. But don't forget, doctors carry a lot of the goodwill themselves. If there is a price tag, how will it be funded? Will it be cash or debt? And what's a payback period for such a purchase? Just jumping across to the right slide there, establishing and buying rooms. So if you're looking to establish your own rooms, you need to think about the actual purchase of the rooms, the equipment you might need, and then the fit out, of course. Who should own it? Well, it's who owns the practice and who owns the rooms. They're two different things, okay? So you never want to own the rooms inside the practice entity, just because there's an element of risk attached to, if I have an entity that employs people, you don't want to necessarily own any assets in that. Okay, we keep those things separate. So a service entity, as we talked about before, might be a company, but if we're buying rooms, what structure do we set up? Now this is where it gets a little bit complex, and certainly seeking financial advice on this decision is really important. If you're doing it by yourself, you may do it directly in your self-managed super fund. Or if you're doing it with some of your peers, then you might set up a unit trust with the units in that unit trust owned either via a self-managed super fund or a family trust. Now there's pros and cons to both. We don't have time today to go into all those, but seeking financial advice before making such a big decision is super important. Now the financing. How much can you borrow? Do you want to borrow 100%? Do you want to borrow 50%? These things need to be considered based upon the cash flows of what you're buying. The banks are generally quite generous with doctors. They see them as a good person or good business to lend to. But certainly it may not necessarily mean you want to borrow 100% for the purchase. If you've got some cash and equity available, a part contribution is a good idea. This is where partnering with holistic medical specialist mortgage firms and brokers really helps. You know, firms that have access to those medical specific lending policies. There's banks out there who really favour dealing with doctors, and understanding who they are is really important. The loan structure you should take into account not just the interest rate. That's obviously very important to try and get a very sharp rate. But other things to consider is tax planning, the flexibility of the loan structure, and your overall financial planning needs. You know, how quickly do we want to pay down that debt? Do we want to use cash, or do we want to invest that cash elsewhere? Is there other priorities we need to think about? This is a really complex piece, buying rooms and the financing to it. I say that again, seeking financial advice is really, really important. Well, that's it from me. Thank you for listening. My name is Hugh Walsh. I'm a director at Walshs Practice. If you have any queries, you'd like to reach out, please feel free to scan the QR code. Thanks again.